Sam Burns, Chief Strategist at Mill Street Research, is here. We're talking stocks, and this is the Money Life Market Call. Welcome to the Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they put it all together. And the way it's all put together by my guest, particularly interesting, because Sam Burns is Chief Strategist at Mill Street Research, which is an independent research company that, well, they've got institutional research tools that help them looking at macroeconomic indicators, looking at asset allocation, and yes, looking at stock selection. Sam's got more than 20 years experience as a strategist, and if you want to learn more about what he is doing, millstreetresearch.com. Sam Burns, it's great to have you back on Money Life.
Hey, Chuck, thanks for having me back. It's great.
So we always start with methodology, and it's important that people understand what goes into yours because there's a lot of factors that you want to be looking at and weighing. So explain how the system works.
Sure. Yeah. So the methodology I've used for a number of years now, going on 10, 11 years at least, is a combination of three main factors. And the biggest one is the trend in earnings estimates for a company. So basically, I'm looking at the direction that the analysts are moving their earnings estimates for the next 12 months, looking at it over the next year or so. And it's the direction and the magnitude that matter. It's not whether things are good, it's whether things are getting better. Or if things have been good, if they're getting worse. And that's really the key function in terms of the indicators, is to pick up when that kind of fundamental momentum is shifting or whether it's very strong or very weak. Once you've found some stocks that have good earnings trends, you also want to see if the price trend is supporting that, if it's corroborating the fundamentals. And so we look at the price momentum to see if there's a favorable price trend, if the stock is outperforming on a risk-adjusted basis. And then we also look for valuation, because we don't want to find a stock that where maybe all the good news isn't priced in yet, where the forward price earnings multiple is reasonable to go along with the earnings trend and the price trend. So if we get those three things to line up, the earnings, the price, and the valuation, that's usually a pretty good pick in terms of a buy idea. And then the reverse for sell ideas. So it's all symmetrical. There's a ranking that will tell you stocks to buy and stocks to avoid. So it's not a biased view with only buys and no sells. Like a lot of Wall Street research. So yeah, it's worked pretty well over the last decade or so. It tends to, give you a feel for where their strength and weakness is and helps kind of stay on the right side of the trend for individual companies.
Given the way this works and a market that we've got right now, I'm frequently asking people, hey, is it easier or harder in given conditions to find things you want to buy? We've got an economy where growth is solid, but maybe slowing, et cetera. And as you pointed out, it's really about the earnings trend, but we've had a couple of companies that have driven most of the market action. Are you finding it harder or easier than normal to find buys, or the system doesn't work that way in any conditions?
Well, no, it has actually been a little bit easier to find buy ideas, or at least stocks that have positive earnings trends lately. After the first quarter earnings came out the last month or two, analysts have actually become more positive on their outlook for earnings in my work. And you're right about certain companies have a lot of weight in the indexes, and those companies have been driving the S&P 500, the major indexes, in terms of performance or in terms of earnings. But if you look at the whole broad kind of swath of U.S. companies, most of them have seen improvement in their earnings trends recently. I think that's partly the macro backdrop and the results we saw and the guidance we got from companies after Q1 earnings came out of the last month or two. So I think people had been worried there would be a slowdown in earnings, and then there wasn't, and it's actually looking a little better, and interest rates are not hurting as much as they thought they were. So we've still got a pretty good earnings backdrop overall from my work.
So what stands out to you now? What's an example or two? Maybe we should start with sectors that you particularly like, but of where you want to be putting money to work right now.
Yeah, for the most part, it's still generally kind of the more cyclical sectors of the economy. Technology has been strong for a while, but I'm actually getting a little less positive on that one. It's become a lot narrower in terms of the earnings trends than it had been previously. And whereas things like financials are pretty strong, the industrial sector has a lot of strong areas in it. And then there are parts of other sectors that have been doing well. What we've also found is that even within some of the big broad sectors, there's a lot of kind of internal divergences, a lot of cross currents. So that some industries are doing very well, and then other industries within the same sector are doing poorly. And so you really have to kind of look a little more granularly at the industry level, kind of the more narrower groups, than at the big broad sectors overall for the most part. But I would say probably the more cyclical and tech related areas are holding up pretty well. A lot of the commodity related sectors and some of the defensive areas, not as much right now.
And in terms of where we're at with the Fed having not cut interest rates, which of course everybody expected, that changes things for financials. What have you got that maybe has played out better or worse given the interest rate picture?
That's right. Yeah, and it's been an interesting path to watch. People kind of keep predicting the Fed going to cut rates, and then they don't, and then they keep predicting some more, and it goes back and forth. And the Fed hasn't done anything really since last July, but the bond market has been up and down as though it were on a trampoline. And so it's been more of a market driven thing than actually the Fed itself. But yeah, for financials, a lot of them benefit from the higher rates we've got right now. They can make more money in that environment than they did back when interest rates were near zero. And but the fact that the yield curve is not is relatively flat or inverted, at least for the treasuries, is less supportive. And loan demand has not been as strong for banks. So what you've seen is that a lot of the financial services companies, like maybe the exchanges or companies that do payment processing or things like that, have been doing well. And the insurance side of the financial sector has been doing very well. They've had a lot more pricing power than they have for quite a few years now, and they've been able to lift their earnings quite well. Banks, are kind of a mixed bag. There's some very strong ones, but there's also a lot of the mid and small cap banks that are still struggling with either commercial real estate or their balance sheets are still not quite where they should be. So they can still make money. There's still a way for them to make money lending, but they've still got some things to work through. So you really have to be careful within areas like banks right now. And that's why I say financials as a sector is doing okay, but you got to kind of pick the right areas within it. Same thing in industrials. Some areas have been very strong, a lot of help from stimulus, a lot of manufacturing, construction going on. Other areas like air freight or ground transportation, the truckers have a lot of oversupply and they're really struggling. So within the same sector, you can see a lot of some strength and weakness right now.
Is there a name or two that's representative of the research where, here's what you particularly like right now? What stands out to you?
Sure. Yeah. So, I mean, in terms of a lot of the big cap names that everybody knows, things like Nvidia is still strong in my work. It's been strong for a long time now, for months and months and months, and still is. So even though it's had such a big run, it doesn't show up as especially overvalued, and analysts are still raising their estimates aggressively for it. So I would stay with that one as an example. Google is another strong one within the kind of the tech related space. Amazon is pretty much single handedly holding up the consumer discretionary sector in terms of the S&P 500. And whereas, like, for instance, Microsoft within the tech sector is not very strong. It's relatively weak in my work. Tesla is not a tech stock, strictly speaking, but people often talk about it like it is. And that's been very weak for a long time and still is. So I probably avoid that. Oracle is another one that's relatively weak within, kind of big cap tech or AMD. A lot of the semiconductors are not particularly strong right now, even though some of them have had big runs. The fundamentals, the earnings estimates aren't really there for most of them, except for things like Nvidia. Those are kind of some of the areas. JP Morgan and Bank of America are the big banks that are really holding up well. If you're going to own some banks, you probably want to look at things like those. And then there's some of the more defensive areas. Consumer staples like Walmart and Costco are holding up pretty well. So if you want something that's a little safer, a little less volatile, you can look at areas like that. But I'd probably avoid Home Depot is not looking good right now, for instance.
With most people, I'm looking at sell methodologies. For you, obviously things change. So in other words, if you're looking at some of the names that you were talking about that are now relatively weak and are avoids, they're in some cases like a Microsoft, which I need to disclose in my portfolio since we're talking about it here. At one point, I believe you liked that stock. So what turns it from, green light to red light? It's not necessarily buying to selling always, because it's not necessarily that you owned it, but what is it that makes you go, okay, I'm now at a spot where this is no longer, this was there and now it's got to be out?
Yeah, no, that's right. Yeah, I mean, a lot of last year, Microsoft looked a lot better. It had positive earnings trends and, was doing pretty well on a performance basis. But what we've seen in the last maybe 2 or 3 months has been that the earnings momentum has really slowed down. Analysts had been raising their estimates pretty consistently. Now they've kind of gone flat to slightly down. They're kind of a 50-50 toss up at best. in terms of the direction of their change in their earnings estimates. So when I start to see that, where a company that had been seeing pretty consistent earnings estimates going up, month after month, quarter after quarter, and then they kind of stop and start to slow down, maybe turn a little bit more negative, particularly if the stock has had a big run, which Microsoft did, that's usually a warning sign that it's probably time to step aside and look for better opportunities elsewhere, because stocks like that have had a lot of enthusiasm and a lot of momentum and have lost it can be at risk sometimes. And sometimes they go down a lot. Sometimes they just kind of go sideways for a long period and they're kind of dead money. And you're just, you're not, making anything by holding on to them, and you could have reallocated into something, stronger. So yeah, it's very much a process of continually, looking for the stocks have the strongest earnings trends, good price momentum, and that just evolves over the course of, 3, 6, 9 months at a time, typically.
Now we're going to get your quick and dirty take on some stocks my audience is particularly interested in.
Quick and dirty.
Always account for variable change.
Well, you heard just now how Sam accounts for variable change and where he's moving to things. But if there's enough earnings momentum, that's the kind of thing he's going to like. If you want to learn more about Mill Street Research and the work Sam does, it's millstreetresearch.com. Sam Burns, my guest, is Chief Strategist there. Quick and Dirty is our lightning round. You know how it works. Participate if you want by sending me picks. Chuck at moneylifeshow.com. We'll add them to our list. And you were talking about financials. We'll start with a request we got from Greg in Short Hills, New Jersey. He wants to know about Euronet Worldwide. That's EEFT.
Yeah, that's right. Euronet is one of the stocks in the financial services industry that I mentioned. That scores quite highly in my ranking right now, and it's basically benefiting a lot from the strong stock market and earnings that have been supporting it. And there's a number of other companies like that have had stronger returns and stronger earnings from the backdrop that we're in. So if you want to take advantage of a good stock market, higher interest rates, that's a good one to play.
Go get all your money.
That's buy on EEFT, Euronet Worldwide. Now, some folks would put REITs into that category of financial companies. They might be a little bit on the side of it. Greg had another request, this for Centerspace. That's ticker CSR.
That's right. A lot of the REITs in general have been weak, and a lot of them still are in our work. They're struggling to find stocks that have been able to kind of overcome a lot of those, the lack of demand for office space and things like that. That have been a problem for quite a while now, and along with higher interest rates. But Centerspace is an example of a residential REIT that's starting to see improvement in earnings estimates just in the last, say, 2 or 3 months. It's a relatively new, what I call an inflection point in earnings estimates. The stock has had a pretty good bounce lately. The valuations are relatively low compared to where it's normally trades. So it's been underperforming for a lot of the last 2 years, but it's really started to turn just in the last couple of months. So if you're looking for a REIT in sort of a strong stock in a relatively weak sector, that's one to look at.
Just follow the money.
Yeah, follow the money towards Centerspace, CSR. Our next request, different kind of REIT, for Rich in Orchard Beach, Maryland. He wants to know about Health Peak Properties, which was Physicians Realty Trust. It's ticker DOC.
Yeah, and Health Peak is another example of one where it's been basically a 5-year downtrend in the relative performance versus the market, and in the earnings estimates for Health Peak. But again, we're just in the last say 2 months starting to see signs of a turn, that analysts are no longer cutting their estimates like they had for so long, and are starting to raise them, and the stock is actually starting to act a little better. So it's got a nice low multiple in terms of the stock's price relative to its funds from operation, which is the kind of the earnings for REITs, and it's starting to turn on a price basis. So that's one where, again, an early inflection point. Can't say for sure, but it looks like it's got signs of an upturn there.
So you're not quite there yet.
Right. Again, if you're looking for a REIT to buy, you want to find ones where at least there's signs of improvement rather than signs of deterioration. And Health Peak would be one of those.
So Health Peak Properties, DOC.
I'm just taking my time before making the move.
Liking the looks of it, but waiting a little longer before buying. Joe in Parker, Colorado wants to know about Emerson Electric, EMR.
Yeah, so EMR is part of the the industrial sector that has had some tailwinds for a while now, thanks to a lot of this kind of stimulus-related spending in manufacturing, as well as general support from the economy. and it's had pretty persistent earnings upgrades for probably a year now and still does. The stock has pulled back actually somewhat recently. It's on a relatively moderate multiple compared to where it normally trades. So you're not paying a lot for the pretty persistent earnings upgrades that it's had. So it's probably a little bit undervalued relative to the benefits that you're getting from the earnings trend. And if analysts are still positive, the stock's pulled back, that's usually an entry point. So it looks pretty good to me.
That's a buy on Emerson Electric, EMR.
Come on, let's buy.
And last for Scott on Whidbey Island in Washington, it's Delta Airlines, DAL.
Yeah, the airlines, some of them have been looking a lot better in my work lately. They have kind of, mixed trends of a lot of demand for air travel, but also, concerns about overcapacity for some of them. But Delta and a couple of the other ones have started to look better. In the last 2-3 months, we've started to see analysts really start raising their estimates for Delta again after a downturn for 6 months or so prior to that. So, a lot of the airlines are pretty cheap. They're only trading on 6 or 7 times forward earnings estimates. The stock price has been acting better the last few months. So again, if you got earnings estimates rising, price acting better, and a relatively cheap valuation, that's a pretty good setup.
And so we finish on a high note, but with a soft landing. That's a buy on Delta Airlines, ticker DAL. And yes, we have come to the end of our journey and touched down, so we have to say our goodbyes to our seat partner here. That's Sam Burns. Sam, thanks so much for joining me on the show.
My pleasure. Thanks for having me.
Sam Burns is the Chief Strategist at Mill Street Research. Find them online at millstreetresearch.com, on Twitter or X at millstreetst, millst research. And we'll be back to let you know where Sam agreed or disagreed with some recent guests, and then we'll cross the finish line together right after this message.